All right, let's just jump right in. Welcome back to another explainer. Today, we're strapping on our expert analyst hats and running an intense stock analysis. We're going to push a high-flying semiconductor powerhouse through an absolute gauntlet of legendary investing frameworks. The target in our crosshairs? Monolithic Power Systems, ticker symbol MPWR. So here's the game plan. We're stress testing MPWR through 6 different analytical lenses: the Buffett lens, the Peter Lynch lens, the Graham lens, a DCF valuation model, some alternative valuation models, and finally, our synthesis and final recommendation. Let's get to it. Before we kick off the gauntlet, let's lay down our baseline. MPWR is currently trading at a massive premium. We're talking about $1,312 a share, giving it a market cap hovering right around $64.5 billion. Their core business? High-performance power management solutions. And get this, they've just posted a staggering 97.7% year-over-year surge in their AI-driven enterprise data revenue. So yeah, the momentum is undeniably there. But our job today isn't just to gawk at the growth. We need to figure out if that sky-high price tag is actually backed up by the fundamentals. Okay, step 1 of the gauntlet, the Warren Buffett lens. Here, we're hunting for a wide economic moat, rock-solid management, and stellar, predictable financials. And qualitatively, MPWR absolutely breezes through Buffett's checks. They've carved out a huge economic moat, providing crucial power solutions for the explosive AI and server markets. The earnings are fantastic too. Q1 net income came in at $193.2 million, up over 43% year over year. The return on equity, a very solid 19.58%. But honestly, the most Buffett thing about this company is its balance sheet. They're sitting on $771 million in total liabilities, which is practically a rounding error compared to their massive $1.06 billion mountain of cash. If you want to sleep well at night, this is exactly the kind of financial fortress you look for.
But, Buffett isn't just about a great business, he's obsessed with paying the right price. If we take their Q1 operating cash flow, about $250 million, and annualize that, we get a proxy of roughly $1 billion in annual owner earnings. Now, buying a business that generates $1 billion in cash for a $64 billion market cap, that gives you zero margin of safety. None. So while Buffett would absolutely love the business itself, his verdict would be pretty clear. Wait for a massive market dip to get a much better entry point.
All right, let's pivot to framework number 2, the Peter Lynch lens. Here, we're zeroing in on the company's growth category, along with Wall Street and insider sentiment.
Right off the bat, Lynch would slap a label on MPWR. Given their explosive 26.1% overall year-over-year revenue growth, heavily driven by that insane 97% spike in enterprise data, Lynch would confidently categorize MPWR as a classic fast grower. It's expanding at an aggressive, thrilling rate, which is exactly what we want to see when tracking these AI tailwinds.
But here's where things get a little sticky. 2.33. That is MPWR's PEG ratio, price to earnings divided by the growth rate. As you likely know, Peter Lynch strongly prefers a PEG of 1.0 or lower, where the growth and price are perfectly in sync. A 2.33? Yeah, that tells us the stock's price is basically outrunning even its own phenomenal growth rate.
On top of that, Lynch always hunts for those under-the-radar gems with heavy insider buying. But look at this data. We're seeing aggressive insider selling, about $112.7 million worth in just the last 90 days. Throw in a massive institutional ownership rate of 93.46%, meaning Wall Street is already all over this thing, and the Lynch verdict becomes crystal clear. Sell, or at the very least, avoid at these current levels.
Okay, brace yourselves, because step 3 is the most ruthless test we have, the Benjamin Graham lens. We're stripping away the hype and focusing purely on traditional intrinsic value and downside protection.
Running through Graham's defensive investor checklist, MPWR actually looks fundamentally bulletproof at first glance. It easily passes the tests for adequate size, strong financial condition, and earnings stability. It even nails the dividend record with 9 consecutive years of payouts. But then we hit the moderate PE test, and it spectacularly derails. Graham wanted a PE under 15. MPWR is flying high at nearly 95.
Let's actually put a hard number on this, using Graham's classic intrinsic value formula. We take the square root of 22.5, multiply it by the estimated annual earnings per share of $20.26, and then multiply that by the book value per share, which sits right around $74.85. Crunch those numbers, and you get a Graham intrinsic value of exactly $184.69.
Just let that sink in for a second. We've got a Graham intrinsic value of $184 up against a current market price of $1,312. That huge, glaring gap tells us that a hardline, traditional value investor wouldn't touch this stock with a 10-foot pole, not without some catastrophic, world-ending market correction.
All right, let's step out of the past and into some modern quantitative modeling with Step 4, the discounted cash flow, or DCF valuation. Let's see if future cash projections can somehow justify this massive premium.
Building our base case DCF, we've got to lay out our assumptions. We're using that annualized Q1 operating cash flow of $1 billion as our starting proxy. We project that over a 5-year forecast period. For the discount rate, we're applying a standard 10% weighted average cost of capital, and we'll assume a healthy 3% terminal growth rate into perpetuity.
Now, even when we run a highly generous sensitivity matrix, tweaking the discount and terminal growth rates to really give the company the benefit of the doubt, just look at these numbers. Even with a super favorable 8% discount rate and a 4% terminal growth, the fair value per share peaks at around $600. If you're running your own models at home, seeing a gap like this is a massive red flag. The math is literally telling us that the market is already pricing in a flawless, uninterrupted decade of hypergrowth just to justify that $1,300 share price. Let's keep digging. Step 5, applying 2 alternative valuation models. We really want to leave no stone unturned to see if there's any hidden justification for this price. First up, a quick comparable analysis. And wow, it really highlights the nosebleed heights we're dealing with. MPWR's PE of 94.59 completely dwarfs the broader market average of about 25. Honestly, it makes the notoriously expensive tech sector average of 35 look like an absolute bargain bin deal.
Next, if we try tossing in a dividend discount model, or DDM, we hit a brick wall. Yes, they technically pay an annualized dividend of $8, but at this share price, that's a microscopic 0.61% yield. Because the actual cash return to shareholders today is so tiny, a DDM valuation is forced to rely entirely on incredibly aggressive future assumptions rather than any tangible present-day value.
Okay, we've officially survived the gauntlet. Now for Step 6, synthesizing all this data to lock in our final, expert verdict on MPWR.
Pulling all these threads together paints a stark picture. Let's be real for a second. MPWR is an incredible, practically debt-free fortress of a business that is absolutely crushing it in the AI-powered space. But as analysts, we have to respect the math. Literally every single valuation metric we ran, Buffett's margin of safety, Lynch's PEG ratio, Graham's intrinsic value, our DCF models, they all scream the exact same thing. This stock is priced for absolute, unwavering perfection.
Because of that, our final recommendation is a hold if you're already in and riding the momentum. But for deploying new capital today, it's a strict avoid. Which leaves us with the ultimate question you really need to ponder after this explainer. Is it ever actually wise to pay a 94 PE for a semiconductor stock? Or is the AI revolution genuinely rewriting the fundamental rules of intrinsic value? Only time will tell if gravity will eventually pull this one back down to earth. Thanks for hanging out with me for this deep dive.